that much more in Thai baht. However, they're going to be reimbursed the difference by the bank. That's how the NDF works in its US dollar equivalent, because the US dollar value of the payable is greater at maturity, at settlement, than it is at origination. And that's when the customer, the company, gets reimbursed. Why otherwise would they put on the NDF? The point of the NDF is to protect the company against the potential appreciation of the local currency, which is exactly what happened here.
Okay, so the currency is strengthened, so they're gonna be reimbursed by the bank, and if it goes down, then they or
They're going to reimburse the bank the dollar value or whatever the depreciation is. In other words, what the NDF does is it locks in the value, the US dollar value of the payable. They're not going to pay more, but they're not going to pay less. And if the currency strengthens, the bank will reimburse them. If the currency weakens, they will reimburse the bank. Good evening, everybody. Hey, Nicole, is that okay?
yes, yes, thank
All
you.
right, that's great. Sure. I'm going to hit the computer.
This meeting is being recorded.
And I'm going to get started. Good evening, everybody. Welcome back. I'd like to spend some time tonight going over economic data that I'd like to talk about. I'd like to look at some of the data we've been considering since the beginning of the semester and see how those economic metrics have performed and where we are overall in terms of domestic activity and global trade and whatnot. And then, of course, I'd like to talk about the final. So let's get started then. And okay, so last Wednesday we met on the 12th. The market had lost upwards of 1,500 points. I'm talking about the Dow. And the reason was why. Can anyone tell us? Two key data points came in that had the markets upset. What were they? We had a weak jobs report, and we had a strong inflation number. Okay? That said, on Thursday, what happened? We got some strong jobs numbers. Initial jobless claims fell below 500,000 to a pandemic low, as headlines cited. Businesses seek to hire more workers. So that was a terrific number on Thursday, right? Relative to where we've been over the course of the last year, 14 months or so, where monthly jobless claims have often been well above 500,000, only just came under 500,000. So that was a big positive. On continuing jobless claims, those continue to trend downward. The week before they were 3.7 million. Now they're at just 400,000 less at 3.66 million. We do know, however, that doesn't tell the whole picture, right? There's more to this picture, which is that there's continuing benefits, right, as listed here. So there's state, local, and federal benefits, yes, many which are attached to the extraordinary COVID benefits that have been offered by the government. And so what do we see is that a year ago, in April, we saw that it was 21.8 million people that were getting ongoing unemployment benefits. Now it's just under 17 million. So it's a drop of almost 23%. That's terrific. But what? There's still a long way to go. There's still a lot of ground to be made up on in the labor markets, which is why what? The Federal Reserve's position about remaining vigilant and committed to its accommodative position carries with it a lot of logic, because the numbers suggest that that's what's needed at this time. And so, again, we met on Wednesday. The market had lost 1,500 points, a couple of 2% in a few days. That was a big hit because of the weak job numbers, the strong CPI number. We saw strong jobless numbers come out on Thursday. And again, we saw that the unemployment rate, where is it? It continues to trend downward from a high of almost 15% to where it is now. We saw a little bit of a jump because of a momentary blip in rehiring that happened last month. Also, the expiration of some of the benefits, so some lighter spending. Anyway, you mute your. Okay, so The unemployment rate is doing what it's supposed to do as we attempt a recovery, which is continuing to trend downward. So all that's positive. So what did we say on Wednesday would happen with the balance of the week? What was our expectation after the negative reaction to the weak numbers on inflation and job numbers? What did we think market makers were going to do in the next number of sessions? Andrew, somebody? Hello?
I don't know.
Okay, what do we expect the markets to do after doing so badly in the last first couple of days of the week, last week, Monday, Tuesday, Wednesday? We expected them to digest the inflation information, and as some of you pointed out last week, inflation that the Fed identifies as transitory inflation. Things like a sudden 10% increase in the cost of used cars as people begin to get out on the road, a sudden bump in hotel costs and airline costs and food costs, energy costs, that the Fed expects to be transitory, and therefore, once market makers had an opportunity to digest this after the following couple of days last week, we saw the markets return to exactly where we predicted. So on Friday, we got retail sales numbers, which were flat, as you can see, at 0%. Retail sales, if we took out autos, was negative. But again, what do we see? That sales at U.S. retailers fell flat in April as the stimulus boosts fade. So what did we see? We saw that the stimulus payments were running out, the extraordinary stimulus payments, and therefore we saw a bit of weakness or weaker performance in the retail sector. That doesn't mean that people aren't shopping and consumers aren't buying at a healthy clip, just not as much as they were the month before. And so what were the headlines on Friday? The headlines on Friday was that gas prices at its 7-year high as the Colonial Pipeline shutdown spurs panic buying. Is the Colonial Pipeline back on track now? Does anyone know?
Yes, it's back up.
That's exactly right, James. It's back up. It was back up over the weekend. And what we discovered, as we talked about before with destabilizing speculation, is that this was a self-fulfilling prophecy. There really wasn't a gas shortage, but there was panic buying for the fear of gas shortage, just like there wasn't a problem in the oil markets, but people dumped oil so much to the extent that it got negative it went negative. The West Texas Intermediate had gone negative. Brent had almost gone negative in 2000 and in 2020 during the first months of the pandemic. Excuse me, just a second, please. Pardon me, I'm back. And so there were two headline numbers I wanted to look at, headlines on the end of the week I wanted to look at. What did the Fed say? The Fed came out and said that growth will improve significantly this summer. And the quote was, they can't be head faked by weak hiring and high inflation in April. The prediction is that job creation will accelerate and inflation will taper off. And so what did the markets look like at the end of the week? On Wednesday, we were here, right? We lost 1,500 points in a matter of a couple of days on the heels of weak payrolls and soaring CPI data. And over the next couple of sessions, Thursday, Friday, Monday, what do we see? We see that the market largely recovered most of the ground that was lost as a result of sort of digesting this information about the payrolls data and the inflation data. Today, what was the information the data that we got that I wanted to draw our attention to? It was the Home Builders Index, the National Association of Home Builders Index, which remained flat. Here's a question: what are home builders seeing? What is it that they're feeling good about? They're not feeling great, but they're not feeling bad. They're not feeling worse than they were, but they're feeling as good as they were. They're not suddenly canceling their orders because they are fearful of inflation, even though we know that input prices have soared, such things as lumber prices. So let's take a look. Home builder confidence remains strong, but buyers should expect rising prices. That also ties directly into the rising lumber prices. So the housing index that we look at, that we see that this is where we are now. We saw the low on the housing index here during the Great Recession when it fell below 20. Now we see we reached an all-time high following the low point from the COVID recession in early 2020, in the second quarter of 2020, where it's reached now new highs as homebuilder confidence remains quite strong, with the expectation that not only will interest rates remain low, but that there's going to remain extraordinary, because of extraordinary support offered by the Federal Reserve, but that consumers remain eager to buy homes in that type of low interest rate environment, especially with a desire to spread out on the heels of what is now a once in a century health crisis. And so we saw that the housing numbers remain well. What else are home builders seeing? They're seeing that the supply of homes is low. Why is that good if you're a home builder? If there's not a lot of supply, that's exactly right, Andrew. If the supply is tight, then that means that,
shortage.
pardon me?
I said you're going to have a shortage in homes.
Well, it means that, right. In other words, we know that anything below 3 months is considered a buyer's, is considered it's a tight market. It's considered a seller's market. And so we know that it's been trending down, but we expect it to improve as we emerge from this very slow period, as more and more developers and contractors deliver on the projected building that they're expected to do over the course of the next couple of quarters, with the expectation there's going to be significant demand. But you're right, the lower the inventory it is, the more leverage that contractors and home builders have. So that's something that contractors are seeing: a tight supply of homes. They're seeing low interest rates. Another measure of home builder sentiment is, of course, housing starts, which shows how many homes are started over a period of time. And what do we see over the course of a year between March of 20 and March of 21? We see a 37% year-on-year increase in housing starts. That all is very positive for the U.S. housing sector, which represents roughly 20% of the economy. It's a huge portion of the economy, as we've discussed since the early days of the semester, that the housing sector, so many industries feed into the housing sector. Think of all the things that go into a home, from building it to furnishing it to maintaining it. And then building permits, which indicates future construction, as opposed to housing starts, homes that have already been started. Housing permits also, as you see, have increased dramatically over the course of the last year by 30%, all of which is positive. On the flip side is the soaring lumber prices, right? Part of those soaring lumber prices are reflected in the fact that we see here in 2017 lumber prices jumping as a result of the tariffs that were put in place by the last administration. Excuse me, that were put in place by the last administration, and yet they've continued to soar well above those levels of $600-700 a linear board feet, 1,000 feet of linear board, to where we see now we reach an all-time high on lumber prices of $1,700 per linear board foot in early May. They've come back down a bit, but still well above any previous record. The expectation being that there's going to be an enormous amount of demand, there's tight supply, and therefore, and of course, the tariffs that remain in place, bottlenecks delivering lumber from abroad. Canada is one of our biggest suppliers of lumber. And the fact is that events have come together to drive lumber prices much higher, and yet home builders remain extremely confident, and that's of course a positive sign. Another thing that home builders are seeing are low interest rates. So let's see where we are. We're exactly where we were when we started this semester, and we looked at the three critical rates: the prime rate, the Fed discount rate, and the Fed funds rate. They're exactly where they are when we started class in late January, early February. They're exactly where they are, exactly where they were a year ago. So that's what home builders are seeing also, with the expectation that low rates will continue for the foreseeable future, as the Fed has kept telling us. Now, if we look at the yield curve, compare the yield curve between 2019, 2020, and 2021, what do we see? We see the yield curve for this year. What does it indicate to us? Can anyone tell us?
Recovering economy.
We see a recovering economy and a steepening yield curve. Do we have any reason to believe that it won't continue to steepen as the economy recovers?
Nope.
We don't. And do we have any reason to believe that short-term rates will continue to remain low while the Fed continues to keep the pressure on long-term low rates?
No, there's a possibility the short-term rates could increase.
We might see some increase in short-term rates, but in terms of keeping interest rates low on the long end of the curve, so that mortgages remain cheap and that money remains cheap to incentivize borrowers and home buyers, there seems to be little doubt that that's going to continue for the foreseeable future. As the Fed just said, just within the last few weeks, that there's no reason to be talking about tapering now. We're well ahead of that. It's not anywhere on the current radar screen, despite the concerns that were expressed across the market with regard to the inflation news last week. But again, as we predicted on Wednesday, the panic selling that we saw on Wednesday was going to subside over the course of the next couple of days, and the market would recuperate, which is exactly what it's done over the course of the last 3 sessions. Now, in terms of the yield curve and the 2 and 10 year spread, which is so critical, what do we see? We see that it's at 148, which is exactly where it was 2 months ago in the middle of March, at 148, which is the widest it had been since September of 2017. This is dramatically higher than where it was at the beginning of the year at 82 basis points, but this is all in keeping with what Michael said before, which is we've got a steepening yield curve. It's a yield curve that's maturing in light of a recovering economy, and it's exactly what we would expect it to be, but nothing that should raise any big alarms. Any questions or comments here? Okay, pardon me. And we talk about consumer sentiment. We see the same thing. We see the consumer sentiment over the course of last year has continued to improve as a strong vaccination program, other relief measures, financial relief measures being provided by the Fed and the administration, the White House, the U.S. government, Congress, congressional aid, plus strong consumer sentiment, strong consumer spending has all driven consumer sentiment higher. Along with consumer sentiment, we often look at consumer confidence, and we see the consumer confidence has also, from the depths of the first quarter in 2020, continued to improve over the course of the last 14 months or so, as we've been able to respond much more decisively to this crisis. Excuse me. Now, in terms of retail sales, we took an enormous hit during the first and second quarter of beginning of the second quarter in 2020 as a result of the arrival of the COVID pandemic. And what's happened since then? We've seen a tremendous amount of recovery early on, and we've seen some choppy growth along the way, but that the trend is towards improving retail sales as consumers return, as consumers begin to reactivate their lives and gear up on the lives that they had pre-pandemic, which included things like going out to restaurants and going to hotels and going to the movies and going to theme parks and doing all the things that we didn't do while we were all on lockdown. And so the picture here on retail sales, although not entirely consistent since the depths of the beginning of the pandemic, still have been reasonably strong. And the last number that we had in was flat, but it's not a negative. It's not a negative, and in fact followed an increase in retail sales on the heels of all this extraordinary congressional support that we've been getting here in the U.S. By almost 11%, which was a gangbusters number that accounted for an enormous surge in retail sales. So you've got some mixed results here, but overall the picture is positive, and We look at consumer spending, which goes along with retail sales. What do we see? The same thing. We see that retail sales took a major hit in the first quarter of 2020 as the pandemic unfolded, and has done what? Slowly recuperate as the U.S. gets a handle on the crisis domestically. Okay. Now, when you look here at another metric for how the economy is doing, we look at vehicle sales. So how have vehicle sales been doing since we how vehicle sales been doing? Well, vehicle sales, you see, are rebounding. They are recovering consistently. And why are car sales such a great barometer, a great measure for the general mood, sentiment, and of the economy and of consumers? Can anyone answer that question? Why are car sales such an important barometer for an economy, for the U.S. economy?
Well, everyone uses a car, so I think it'd be a good indicator to see what people are doing with their money.
Okay, we've got about 80 million people that drive to work every day, so you have a big. Well, it's an emblem of ability to purchase, of course. It's an emblem, a reflection of more disposable income. Improving vehicle sales mean that consumers are feeling optimistic about the future. It means that consumers are, out of necessity or out of desire, are willing and able to buy a car, which is a significant purchase for just about everybody. And so therefore, improving vehicle sales goes hand in hand with an improving economy, just the way a bit of inflation goes hand in hand with an improving economy, and along with the other metrics that we've been looking at. So that was a good answer. Thanks, Andrew. So we talk about industrial production. We look a bit wider beyond vehicle sales. We look at industrial production, which includes manufacturing production. And what do we see? Industrial production has continued to recuperate since the nearly 10% correct contraction that we saw in the second quarter of 2020, which was the largest contraction on record. It's a 33 or 34% annualized rate. And so it's continued to recover, which is both a positive sign and, of course, also a reflection of the strength of the manufacturing sector here in the United States. Also, construction spending, which ties into the housing sector and other areas of construction. And we see what? We see that despite the contraction that we saw here, where we saw a giant increase in lumber costs as a result of the last administration's imposition of tariffs on imported lumber, along with the giant hit that we took in the first quarter of 2020 at the onset of the pandemic, construction spending has been, since the onset of the pandemic, encouraging. We've seen some reduction. We've seen some reduction since the beginning of the year, but nevertheless, it still remains strong. As we just saw before, the National Association of Home Builders reports a reasonably strong number, not stronger than it was before, but not weaker than it was either. And I think the fact that we had strong inflation numbers and weak job numbers, that we came in with what is essentially is a flat home builders number, was a big positive. So again, industrial production, construction spending, generally a positive story we can take out of there. Now we turn to the labor market. What do we see? We see that job openings have continued to increase. So there's 8.1 million jobs and change that are available. That's great. But how many people are out of work? Can anyone give us an approximate number?
It's like 16 million.
Those are people that are still getting benefits. They may have pulled out of the job market. What is the total unemployed according to the Bureau of Labor Statistics? We've got about 9 million people still out of work. 9 million less people than were out of work before. Remember that in that 16 million people, there are people in there. No, excuse me. I don't want to confuse anybody. It's about 9 million people that are that are considered completely out of work, right? So we've got more people out of work than we have job openings available. We also have the incidence of a mismatch of jobs and skills. And that's one of the challenges that the federal government's going to try to address. We're about 9 million fewer jobs than we were before the pandemic was undertaken.
Professor, does this number count also the one that they're using, they work in part-times, the 9 million?
The 9 million would not include part-time. 9 million does not include part-time. The 9 million includes full-time workers.
Okay.
Okay. So what do we see in jobless claims? Jobless claims have done exactly what we would hope that they would do. They continue to tumble from the high of the beginning of 2020 to where we are now. So that's a positive. What is the Fed looking at, though? The Fed's looking at the total picture, though, which is what we should look at, which is the alternative employment measures, U1 to U6. We looked at in the beginning of this, earlier in this semester. So the official rate, I'm sorry. The official rate is right now hold on a second. I think there's an error here. I need to check that.
6.1.
Yeah, I think there's an error here. And the 6.1 is the official unemployment rate. That's what should be highlighted. Excuse me, folks. That's what should be highlighted is the 6.1. We'll get that fixed. So the Fed's looking at that 6.1%, excuse me. The Fed's looking at that 6.1%, which is great. But a more inclusive number is the U6 number, which includes all of those unemployed, plus discouraged workers, plus those marginally attached workers, plus those people that are employed part-time for economic reasons. So it includes every measure of unemployment that the Bureau of Labor Statistics takes into consideration. And that number is closer to 10%. That was much higher during the Great Recession. It was upwards of 18%. So this is much better. But again, what does it tell us? It tells us the same thing that it's telling the Fed, that there's ways to go. There is still a considerable distance that needs to be traveled before we can say that we have a full and healthy labor market. So taking into consideration all of this domestic data, what does the fear gauge look like? Well, when we came into class, the fear gauge was just a little bit over 30. Right now, the fear gauge is just a little over 23. And so the fear gauge has come down, as you can see, dramatically from where it was at the onset of the pandemic back in the beginning of 2020, where it was well above 80. That's, of course, a very positive sign. So the VIX is telling us that overall market sentiment with regard to domestic affairs is generally more positive than negative. Now, if we look at the foreign exchange markets, what's happened to the dollar over the course of the time that we've been together? When we started class, the pound was trading against the dollar at $1.37. Now it's trading against the dollar at $1.41. So the pound has strengthened a bit over the course of the last few months that we've been together. And the euro has also strengthened a bit against the dollar from $1.21 to $1.22. Is that important or is it negligible? More or less where it was when we started. I think in a broad overview, it's more or less where we started. I don't see anything dramatic that's happened other than the fact that the US has had a more successful vaccine program than we've seen in Europe to really change the dynamic between the dollar and the pound or the euro. However, as the US continues to recover, I think that we will see a strengthening of the US dollar. The expectation is that that should follow by a commensurate strengthening in the pound and the dollar along with the yen as those economies follow the US in terms of their own successful vaccine programs, which currently lag the United States. Not Japan, though, of course, I shouldn't say that. Japan's doesn't, but certainly Europe's does. Japan's, though, recovery still lags the US. So against the yuan, when we started class, the dollar was trading against the yuan at 646. Now it's trading against the yuan at 644. So the dollar is weakened against the yuan, which isn't all that surprising because what's happened in China? China had a much more aggressive approach to dealing with the virus. They dealt with it much more successfully, much more quickly. They dealt with it more successfully, more quickly, and they saw GDP growth. Our GDP growth soared in the last quarter by 6%. What was China's GDP growth rate in the previous quarter? Anyone remember? It was about 18%. So it was significantly higher, about 3 times the US. So I'm not surprised if you'd see a little bit of a weakening in the US dollar, but nothing so significant. Again, the dynamics between these currencies hasn't changed all that much in the few months that we've seen each other. We started the class, we talked about copper prices as a key global indicator because it's a precursor element in the production of so many products. We talked about China being the biggest consumer of copper. And what have we seen? Well, if it is a key economic indicator that goes into so many goods that are made around the world, particularly in China, we would expect that when the global economy comes to a roaring stop and things begin to shut down, that the price of copper would fall as it did. And now, as global demand really begins to pick up, we're seeing that evidenced all over the map, whether we're looking at the Baltic Dry Index or we're looking at right now global copper prices. Copper prices are beginning to soar, just like we've seen lumber prices soar. Excuse me. Part of the problem with lumber prices soaring, though, is it's attendant to the fact that there are still tariffs in place. Nevertheless, lumber prices are increasing separate and apart from those tariffs that remain in place. With copper, we don't see the same tariffs operating here, but we do see a tremendous strengthening in copper prices as global demand gets underway at a very strong clip. Now, in terms of gas prices, which has been of particular interest of late because of the Colonial Pipeline sabotage, we've seen that we've seen that domestic gas prices are about $2.96 a gallon. They've improved a bit. We would expect gas prices to improve. Energy prices fell. The economy shut down. Now the economy is getting back to normal. Demand is beginning to pick up. You would expect commodity prices are going to rise, and one of those commodities are going to be gas prices, car prices, so on and so forth. And so what do we see? We saw that WTI crude is trading at, domestic crude is trading at $65 a barrel. When we started, it was trading at $53 a barrel and change. So it's up 22% in the last few months. And if we look at Brent crude is up 27% in the last 3 months. And if you remember, we saw that other commodity prices, excuse me, we see an increase, a commensurate increase in other commodity prices of anywhere between 20 and 30% as a result of increasing domestic demand. Along with an increase in energy prices, we've seen an increase in rig counts. And what you see here is, it's a 10-year rig count chart, and it shows that rig counts exploded during the oil and shale gas revolution. Oil prices collapsed, rig count collapsed, rig counts have slowly recovered, and now we see a reduction in overall rig counts here around 2019. As oil prices fall, we see a collapse in rigs in the first quarter of 2020. And what's happening here now, we see a recovery of rigs. Now we've got about 350 or 60 rig counts, as opposed, which is a fraction of where we were. But we're seeing an increase in rig counts as oil prices recover, and we're going beyond that $40 a barrel break-even point that is so critical for shale and oil gas producers. U.S. oil production also, so we see exploded with shale oil and gas exploration continues to explode. We see a reduction in oil production beginning in 2020 as a result of the COVID pandemic. And now we're just about, we went from about 13.5 million barrels a day. We're producing somewhere less than that, around 10 million barrels a day. And so, yes, we're producing, roughly 23, 24% less than we were producing before the COVID pandemic. But does that mean that we have an oil shortage? No, we have lots and lots of oil. We've been overproducing for years now, and we've got lots of oil. That's not the big concern. Overall, the energy markets here in the United States are really pretty healthy. And so what has all this done to global trade volumes? Well, we see here that China joins the WTO in December of 2001. Global trade volume was roughly $6 trillion, right? This was just at the same time that we saw the dot-com bust here in the United States. Over the course of the ensuing 7 years, global trade volume nearly tripled. Then we have the Great Recession, where we see trade volumes compress. Then they recover after following the end of the Great Recession in June of 2009. Trade volumes recuperate. They recuperate. We see a tremendous change in the global trade volume. We see a collapse in oil prices in 2015. Then we see recuperation in global trade volume. And where are we now? We've seen a contraction in global trade volume as a result of the COVID pandemic, but still, overall, global trade volume remains reasonably strong, and the expectation is it's only going to get stronger as the economy recovers here in the US and, of course, around the world. Excuse me just a second. I'll be right back. Okay. So, okay, I'm back. Okay, so let's talk about the final. The final is going to be on Wednesday. I'm going to send everybody a text in the morning, an email in the morning, like we did before with the quiz and with the midterm, to confirm that we're on track to begin the final at 8:15. The protocol will be exactly the same as it was before in the previous two exams. I'm going to build in an extra 10 minutes into the exam, as I did before both times, to give you an extra accommodation in light of the fact that we're not taking these exams under normal circumstances. Everyone's at home. There could be a technology issue. I'll be available to you during the exam via email if a problem occurs. But again, follow the instructions, and everything should be fine. The exam is pretty much written. It's about 55 questions, and it's going to look like everything we've done in class over the course of the latter part of this semester, since we started on non-tariff barriers shortly after the midterm. In terms of the calculations, everything we've done in class, you'll see that type of calculation on the exam. I've told you that in terms of welfare effects, I'm going to give you a problem on regional trading relationships. And I'm going to expect you to be able to plot the welfare effects that we did in class pretty extensively. And that'll be a couple of questions. There'll be true, false, multiple choice calculations covering the material that's listed here. And beyond that, this covers everything from includes everything from Blackboard that we've covered, pardon me, so far. since the midterm. And I'm just thinking, what else? I'm going to post the slides from tonight. I'm not testing you on the material that I put up tonight. What I want to do is I want to say, I want to say thanks for coming. Stay safe and good luck. I want to wish those of you that are graduating, congratulations on your graduation, your upcoming graduation. I want to wish you best of luck in all your future endeavors. I want to wish everybody in the entire class good luck on all your final exams. Good luck on completing the semester. I want to wish everyone a happy, healthy, safe continuation of your school year, that you all have a profitable and enjoyable summer, safe summer ahead of you. And to the extent that you'll be on campus when we're all back on campus and you have a chance to come over and introduce yourself to me, I'd be so pleased to meet every single one of you. I've enjoyed working with you. I thank you for your time and attention throughout the semester and ask that you continue to focus on the important things we've talked about as you continue to evolve as global managers. And as I said, a hearty good luck to all of you and a special congratulations to all of the students here that are graduating this semester. I'm very proud of all of you. So thank you all very much. We'll see you on Wednesday, okay?
Thank you, Professor.
Professor,
Thank you so much.
I had a
Thank you,
question.
Thank you,
Professor.
Professor.
Thank you very
Good night,
much.
everybody. Thank you.
Professor,
Yeah,
are there going to be any extra credit on the exam?
sure, there'll be extra credit.
Okay, awesome.
Oh,
Is that included in the 55 questions?
I think so. I mean, I think so. I'm making some edits, between now and Wednesday, but yeah, I mean, it's a fair exam. It's a fair exam. It'll be a fair exam the way that
It's
they
a
turn
lot
it.
of questions, though.
It's a lot of questions, but it's 2 hours. You have plenty of time to answer the questions. So I'm going to give you a serious exam. It's a serious class, and it's not going to be any different. The material will be exactly what you saw. It couldn't be fairer. I'm going to test you on the material we covered. I'm not going to give you trick questions, much like I didn't do on the midterm or the quiz. And I think it's a fair, will give us a fair measure of how you've done in the class. And like I said, if you're comfortable with the calculations, with the conceptual material, you should be absolutely fine. If there are any questions that come up between now and Wednesday, feel free to call me. But beyond that,
Professor, just to recap, you said for the chapter 5, we will cover only the regional trading effects, right?
in regional trading arrangements, that's chapter 8, I think.
Oh yeah, you're right. Sorry.
Chapter 8. So I'm going to give you a series of questions on plotting welfare effects for regional trading relationships. And beyond that,
We also
I
have
think that
chapter 5.
chapter 5, I still want you to know chapter 5. I'm going to ask you conceptual questions about tariffs or non-tariff barriers. I'll ask you some perhaps conceptual questions about that, NTBs. And I'm going to leave it at that, folks. I want to leave on a happy, good note. I'm wishing you all very well.
Professor, I have a question.
Good night, everyone. Thank you.
Professor?
Night. Thank you, Professor.
Thank you. You bet. Thank you.